Hello, everyone, and thank you for joining us for our first webinar in the Beyond the Return series. This is our first sponsored event. If you do not know me, I am Victoria Nunez. I am the Member Services Director for Think Outside the Tax Box. Today's webinar is brought to us by American Revitalization Company, and the host for today's webinar is Steve Austin. He is a partner at ARC. I also wanted to let you guys know, if you have any questions, please utilize the Q&A tab if it is a question for Steve. All other chats can utilize the chat section, please. Steve, I will have you come on and share your screen. Yes, looks great.
Great. Are we ready to get started, or should we give everybody a second?
We can, yeah, let's get started. It's 11:01.
All right, fantastic. Well, appreciate everybody for joining us today. As Victoria said, my name's Steve Austin. I'm one of the 4 partners at American Revitalization Company, and we hope you guys enjoy the Tax Tango presentation we have prepared for you today, which is at a very high level. It's about using tax dollars to acquire real estate and strategically build wealth. I will take Q&A throughout the presentation as well as at the end of the presentation. So as Victoria said, if you do have questions, please use the Q&A panel so she can find an opportunity to interrupt me, and we can address those questions as we go. Want to make sure this is very informative. We are not going to go and do a deep dive into the ARC investment fund. That's not really the purpose of this call. This call is really intended to go into the tax side of things and go into some tax planning opportunities around some legislative changes that happened at the end of last year. But to give you a very high level overview of who ARC is, we're committed to preserving historically significant real estate and businesses in local communities throughout the United States. Our strategy is really to leverage federal, state, and local tax incentives to de-risk enhanced returns for our investors. And by utilizing, these incentives and our experience in investment management, it allows us to create value not only for our investors, but for the communities in which we invest. So that's a little bit about kind of who we are. A little bit about my background is I've had a very diverse background, everything from working in the public sector to working in an operational capacity for a $7 billion private equity fund. I spent about 15 years in private wealth management, doing high-end estate planning and tax mitigation planning for high net worth individuals. I've started and founded and grown my own small businesses over the years. So I've really run the gamut, in a vast different array of areas. Currently, I'm acting as a CFO and COO for a decent size law firm here in the Bay Area. As well as leading the acquisitions and underwriting and M&A activity at ARC. So that's a little bit about my background. Today's topics, we're really going to dive into the changes that Congress made at the end of the year as part of the Omnibus Act, specifically around Code Section 170H. We're also going to touch on the tax court ruling that threw out the listing transaction notice 2017-10 that was invalidated for failing to follow the Administrative Procedures Act. We're going to talk about the new exceptions and carve-outs in the new law that was enacted at the end of the year. And we're going to actually get into some of the details around what is a certified historic structure according to the tax code, what qualifies. We're going to touch on the difference. A lot of people are familiar with the Historic Tax Credit Program, which is for rehabilitating historic buildings. Not as many people are familiar with the Historic Preservation Easement Program. So we're going to really highlight the differences between both of those and talk about situations about how we might use each of them or both of them. And then I'm going to dive into the new landscape for tax professionals, to navigate and the opportunities that we feel are there. And we're going to give you 4 very specific, actionable strategies that you can take back to your clients immediately for 2023 tax planning. So that's kind of the general gist of what we're going to get into. So to start off the presentation, the IRS has their dirty dozen list. I'm sure most of the people on this call have heard of that. But really, these perpetual easements, or a lot of people refer to them as conservation easements. they really are not part of this dirty dozen any longer, simply because of the legislative changes that Congress enacted at the end of this year. 170H has been one of the most widely villainized and attacked pieces of legislation in the history of the country, probably. This bipartisan law was enacted over 40 years ago. I believe this is the fourth legislative change it has gone through over that period of time. And clearly one of the focal points of this most recent legislation at the end of December was to limit the charitable deductions that folks are taking to 2.5 times an investor's basis. That 2.5 times investor basis was part of the 2017-10 listing transaction notice, which created the listing notice around any syndicated conservation easement that went above that 2.5 to 1 threshold. So for those of you who don't understand what that means, if you invested, $1 and you were getting greater than $2.50 in charitable deductions, it was part of that listing notice where you had to file with the IRS an 8886 to report the transaction. And for that reason, many tax preparers and planners would not go anywhere near that ball of wax because they didn't want to be part of that issue. The current legislation has now made what the IRS was regulating, through regulation. The current legislation has now made that part of the law. So what that means is that for a conservation easement on green land, you are no longer allowed to take a charitable deduction above 2.5 times your basis in that property. So if I buy a property for $100,000, I can't generate a $500,000 charitable deduction for that conservation easement. My cap would be $250,000. The intent of these new provisions, however, are really to stop the syndicated world where you have unrelated parties investing into fractional ownership of these partnerships, right? So if we got a group of 10 unrelated people together and everybody put in $100,000, we have $1 million basis in the property, and we're going to take a $5 million charitable deduction based on the highest and best use of that property. That's really what the IRS was lobbying Congress to remove from the legislation. And so that's really what you'll see here when I go through the exemptions in the law. That's really what we have. When you get into the actual definition that was placed in the Omnibus bill, this is it here. I'll read this verbatim to you guys. So Section 170H is amended by adding at the end of the following new paragraph, Paragraph 7, limitation on deduction for qualified conservation contributions made by pass-through entities. And it goes on to say, in general, a contribution by a partnership, whether directly or as a distributive share of a contribution of another partnership, shall not be treated as a qualified conservation contribution for purposes of this section if the amount of such contribution exceeds 2.5 times the sum of each partner's relevant basis in such partnership. So effectively, that's the 2.5 to 1 limit. As we go further into the legislation, however, they created numerous exceptions to that rule. The first exception is outside the 3-year holding period. So if those 10 individuals get together and they buy that piece of property in 2020 and they wait until January of 2024, so the 3 years and a day holding period, they are no longer subject to that 2.5 to 1 basis limitation. So their $1 million acquisition of that property could yield a $5 or $6 or even a $10 million valuation of the charitable deductions. And that has created a lot of positioning for people to hold on to these properties. However, that is a clear, strike against any of the syndicated, easement companies out there that are basically offering, they're going out and acquiring the property and then offering, these fractional units of partnership interests to the investors on an annualized basis to do annual tax planning. Now, if you wanted to take advantage of this exemption, you'd have to plan 3 years out in advance. One of the other key exceptions is for family partnerships. So if you have a high net worth individual client, they have significant taxable income, maybe a family business, and they wanted to use the charitable deductions just for their immediate family members. Okay, and there is definitions clearly labeled in the code who qualifies as a family member. Those individuals are also not subject to the 2.5 limitation on their basis. So what that essentially means is, if you have related parties doing a conservation easement, they do not have any legal limitation other than what they can demonstrate as the highest and best use valuation of the property. So if they have a property that could be a $40 million valuation, even though they paid $1 million for it, that's a 40-to-1 charitable deduction, that would be eligible. As you can all see, Victoria put up the first poll question here. If everybody could take a second and go ahead and respond to that, I will keep on going, through it, through the presentation, that is. The other exception to the rule that Congress enacted is to preserve certified historic structures. So subparagraph A shall not apply to any qualified conservation contribution, the conservation purpose of which is the preservation of any building which is a certified historic structure as defined later on in the code. This is the primary focus of our topic today. Based on this exemption to the 2.5-to-1 basis limitation, we feel that there is a tremendous opportunity to focus in on this particular opportunity, or as we like to call it, the blue ocean, and we'll get into some of those opportunities in a little bit. But by preserving certified historic buildings throughout local communities, the investors they don't have any limitation legally on the multiples of the deductions that they're allowed to take. And then we get into what is a certified historic structure. A certified historic structure, for the purposes of this paragraph, means any building, structure, or land area which is listed in the National Register, any building which is located in a registered historic district and is certified by the Secretary of the Interior to the Secretary as being of historic significance to the district, a building, structure, or land area that satisfies the preceding sentence, if it satisfies such sentence either at the time of the transfer or on the due date, including extensions for the filing of the transfer's return under this chapter for the taxable year in which the transfer is made. So let me summarize. A historic structure that is a certified historic structure as per the code is any historic building that is on the National Park Service's registry of certified historic buildings or places. So there are currently 1.8 million qualified historic structures under the National Park Service's registry. Those are the properties that are eligible for these charitable deductions. In addition to that, every state throughout the country has what's referred to as a SHPO, State Historic Preservation Officer. And the officer of the office their sole responsibility is to work around the state to identify these historic structures that are meaningful to the history and culture of these local communities. And they work then with the local property owners to try to get these individual properties listed, or in a lot of cases, it's a downtown historic district, which they say, hey, every building in this district is part of our historic culture, and we want to preserve and protect these assets. So that is essentially what's going on here in these historic structures and so forth. Now, to summarize the big changes, some of the other parts of this new legislation is last year, in going in reverse, there was no maximum legal multiple, although the IRS was heavily scrutinizing any deal that was above 2.5 times the investor's basis. Those were listed transactions prior to November of last year. In addition, you could write off up to 50% of your AGI each year with an investment into a qualified conservation easement, okay? And you had a 15-year carry forward. Now, under the current legislation, you have a maximum multiple of 2.5 times your investment, unless you meet one of those exemptions that we discussed. And you can still do a 50% reduction of your AGI each year with a 15-year carry forward. So that's really the difference, is you have to have one of the exemptions to exceed the 2.5 threshold. Other than that, not really much changed. So let's get into what is a historical preservation easement. Now that Congress has explicitly protected charitable deductions associated with these historical easements, okay, this is a very viable planning strategy for clients and their tax planners. So let's get into kind of some of the fundamentals, how it works, and kind of what it looks for. Of course, you'll hear the term, hey, a house has good bones. It's very similar in this realm. We're looking for properties that have good bones. We're looking for properties that, meet the criteria for qualifying for the program, meaning they're one of the 1.8 million certified historic structures across the country. But we're also looking for properties that are, desirable markets that you want to acquire real estate in. Okay, they have solid fundamentals, right? They are a piece of real estate that somebody would want to own. We're not looking necessarily at, the typical dilapidated old warehouse or manufacturing facility that needs millions of dollars of renovation. That would be a great candidate for the historic tax credit program or the HTC program, but not particularly an easement program. Once we identify assets in these markets that are certified, we're looking for municipal zoning ordinances that allow for upward development on that property, even though it is a certified historic structure. So while many people think, well, hey, if once it's on that national registry, there's nothing I can do to redevelop it, that's not the case. Many local zoning ordinances are very pro-development. If you look at cities like Miami, which has gone through a major rehabilitation of its zoning code, Charlotte's going through that right now. Nashville is very developer friendly. Birmingham. So there's a lot of these cities that are very pro development right now. And even though these assets are certified historic structures, they don't restrict the development of those properties in any way. So that's kind of the perfect marriage of what we do at ARC. Is we're looking for those properties that a developer could tear down and get rid of that historic structure and build their 20 or 40 story tower upon that property, right? Those are the perfect opportunities to preserve that historic structure. And that's really where our focus is. So we look at markets. We want good, strong, fundamental markets. Typically, if it's a really good, strong housing market, it's going to be a good commercial real estate market. With that being said, there are certain things that we do look for. Give you guys an example: a 2-story, 30,000 square foot asset zoned for 20 stories of high density housing. Okay, we have a property that we'll be doing this year in the current fund that is exactly that. It's a 2-story, 30,000 square foot office asset today, but it is zoned and permitted, zoned for a 20-story high density housing property, right? So the highest and best use in a downtown urban market would clearly be housing in a high density capacity. So that's kind of what we're looking for. So we're looking for these assets that have that upward potential, the development rights to go up, but we want to then say, hey, we're going to forego that development right through this historic preservation easement. And then we're going to determine what the value of that is. What's the lost opportunity of protecting this building in perpetuity? And so that's where the tax code gets into something called highest and best use. The process integrates a zoning review with a market study to quantitatively determine what's the most valuable development opportunity for this property. They look across hospitality. So they'll look at kind of a low end, a mid tier, and a high end hotel property. What do those sell for in the market on a per square foot basis? What are those costs to build? Then they typically go to your typical multifamily. Again, they'll look at a lower end product, a mid tier product, and a high end product. And then finally, we'll typically look at condos, because sometimes individual condos will sell at a much higher per square foot price than what multifamily properties might be trading at. And so based on that analysis, you have a very quantitative way of determining what is the most financially productive opportunity on that particular property, okay, or parcel. And this is all, stuff that has been tried and tested in court. It's longstanding in the Appraisal Institute. The highest and best use is described as, the reasonably probable and legal use of a vacant land or improved property that is physically possible, appropriately supported, financially feasible, and results in the highest value. So the 4 criteria that a highest and best use must meet to stand up in court are: it has to be legally permissible, physically possible, financially it has to be a feasible development, and it has to have maximum productivity, meaning I have to utilize the space to its maximum ability, right? As long as I can show that, that is the criteria and the case law that has been supported, not just in conservation easements, but across the realm of appraisal case law throughout the court systems. Then you get into, how do we value this historic preservation easement? Once we have that third-party qualitative data, we move to value the easement. In layman's terms, that is the value of the restriction on the deed, which is the lost opportunity of developing it into something else, whatever that hypothetical highest and best use case is, right? So going to, the property that we mentioned, and I'm going to take a pause real quick. The second poll question is up. If everybody could do their part there, Victoria would definitely appreciate that. So getting back into the presentation, highest and best use, the maximum thing we could build on a property is a 20-story apartment tower. Let's assume, for the sake of conversation, it's going to cost us $50 million to develop this. But once it was stabilized and fully leased, it would value out in the open market at about $90 million. Once we place that permanent deed restriction, the HPE, on the property, the owners of the property are entitled to a charitable deduction equal to the valuation of this lost opportunity, which would be the $40 million, right? So $90 million value once it's fully leased and occupied, minus my construction cost of $50 million. If I was the developer and this was my property, I would earn that $40 million in profit, right? So that's the lost opportunity that we're giving up to permanently protect this property from future development. When we do that, we are actually giving the local land trust or historical society the rights to restrict any alterations to the facade or the air rights of the buildings. Okay, so it is a permanent protection that will live on beyond our ownership of the building, our investors' ownership of the building. It lives on in perpetuity. So that is one of the requirements of the law. So the property owners, using a qualified appraisal, now have identified the value of this easement, and they must decide how much of this appraised valuation to report to the IRS on the partnership return. Some people will take 100% of that deduction, others will not. In general, the IRS has been very accommodating when the charitable deduction does not exceed 2.5 times the owner's basis in the property. That's always been their line in the sand. If you don't cross it, they don't have any problem with it. However, if the deduction exceeds this threshold, we'd expect the IRS will continue to audit and attempt to challenge valuations on, these historic easements, just as they would on a conservation easement. So in general, we feel if you stay at that 2.5 to 1 threshold, you're good. If you go over that, you're going to end up in, an audit with the IRS. Again, that's not the individual investors or clients that have to deal with that. That would be on the partnership or ARC in this case. So I always like to clarify that. It doesn't mean that your individual clients are going to, be subject to an audit. Now, to kind of contrast this historic easement program with what's called a historic tax credit or an HTC program, you need to understand that in addition to preserving these buildings and protecting them from upward development, there's also federal and state and local incentives to rehabilitate these buildings. So if you go back to my prior example where you have some buildings that may have been old factories, old warehouses, industrial type complexes, in a lot of urban markets, you'll see these be converted into lofts and housing and things, kind of more trendy things of that nature. maybe it's restaurants, maybe it's, nightlife, whatever the case may be, right? Well, the government has a federal program, and as well as a lot of states have also adopted a mirror program to the federal program to provide a tax credit back to the developer who rehabilitates these certified historic structures to bring them up to current building codes, make sure they're safe, make sure they're economically viable, tax revenue positive assets to the local community, right? So both of these programs, even the federal and the state level, all of this boils down to one thing. The studies have shown conclusively across the country that for every dollar of tax incentives that goes into these certified historic assets, the local community reaps about $4 in additional tax revenues after these incentives have been provided. So that's why these particular programs have been carved out and protected under the new legislation. These are very successful programs that have a long history and tradition throughout the country. And they've been very successful in helping, urban markets revitalize their downtown. So whether it's the HTC program, where I'm getting a credit for up to 50% of the rehabilitation costs if I qualify for that program, or it's a historic preservation easement to protect the building against upward development in its local community, either one of those programs has a pretty long-standing tradition. So 1742, Columbus sailed the ocean blue. What we at ARC, we feel very strongly that this new legislation and the elimination of the listing transaction notice has created a blue ocean, and these historic preservation easements, are going to be the predominant beneficiaries, right? So by being able to take these certified historic structures, these assets that you can acquire that are income producing, stable, valuable assets, and at the same time, I can get a substantial, reduction, as much as 50% of my AGI every year, right? I've created a situation where I can build wealth and enhance my family's, financial future by trading tax dollars for these performing assets. And so we are going to get into, a lot of the different strategies as we kind of move through the presentation here. But I want to just take a quick pause. Victoria, I don't know if there have been any questions you want me to address up to this point.
No, Steve, there haven't been any in the chat.
Thank you. Fantastic. So, all right, what's the problem that we're trying to address, right? We have a lot of high earners looking for legal paths to minimize the amount of taxes they pay, in particular, high tax states like California, Oregon, New Jersey, New York, Illinois, Hawaii, and others, right? So this is going to be a lot more appealing to folks in those higher tax states versus the lower tax states like a Texas or a Florida or a Nevada, okay? But the fact of the matter is that, as many of you know, the federal tax rate is going to sunset back to the 39.6 top marginal bracket anyway. So likely anybody who's in that highest marginal federal bracket, they're going to be very, very intrigued by what we can help them do from a tax planning standpoint. So Congress has reduced a reliable way to offset taxes, and as a result, these syndicated conservation easements are no longer a viable alternative. Most providers are moving into fee simple title donation of property, which carries a maximum tax deduction of 30% against your AGI. Solar has complexities of passive and active income that a lot of times is just too much for most investors to wrangle with, and it just kind of sets the bar a little bit too high for a lot of taxpayers. So the four solutions we want to put forward to you guys today, and to open up some dialogue on, are just a pure investment into the ARC fund as a historical preservation easement for a 50% reduction in the taxpayers' AGI. We'll go through some math on that example. We're also going to look at 1031 exchanges are very popular out there in the real estate community. And we're going to give you guys a wrinkle on, somebody selling a building versus doing a 1031 into one of these historic assets and then taking the, historic easement charitable deduction for themselves. The next one we're going to go through is an example on using this type of a strategy in conjunction with a Roth conversion and what that looks like to a client. And then the fourth one is the balancing of ordinary income and long-term gain income, whether that's the sale of, highly appreciated stock, real estate, a private business. It doesn't really make a difference, but there's an optimization that can be done to blend ordinary income with capital gains, with long-term capital gains income, and using the charitable deductions through ARC to manage that. So those are the 4 different strategies we're going to dive through over the next few minutes here. Strategy 1 is this is an investment for $1 million. John Doe has an ordinary income of $1 million, lives in California, married, filing joint, slated to pay more than half of his salary in taxes. And here's how that would look if he made an investment into ARC, right? So we are making some very basic general assumptions here. The calculator is not designed to, fully give you guys the progressive tax total. These are just based on the marginal rates that these individuals would be hitting. So we understand that. I just want to clarify and preempt any questions there that these numbers are not 100% accurate. They're more designed as just an intro to the conversation. We would do kind of a baseline, calculation like this, and then obviously turn it over to the client's tax preparer, tax professional to get more precise than this. So just a little disclosure there. So if you look at somebody who's in that $1 million tax bracket here in California, they can make a $200,000 investment into ARC. And if you see at the second line down here where it says 2023 total tax incentive benefits, let me go back to that. The total tax refund for that particular client would be $251,500, meaning they are cash flow positive $51,500 in year 1. And that is solely based on the tax benefits before you get the returns on the investment fund itself. When you look at that over the lifetime of the fund, these are some very conservative assumptions that we have put forward for the fund. And again, I'm not going to get into details of the mechanics of the fund from an investment perspective. Everybody on the call is welcome to set up a follow-up with us to dive into that if you have more questions there. But very high level, very conservative projections. The lifetime cash flow of that $200,000 investment would be about $381,500. Down here at the bottom right, on the left, you see the client is paying about $503,000 in taxes on their $1 million of gross income in California. That would leave us a net income or a disposable income of about $497,000. Once you come over to the right, you'll see the $200,000 investment, the reduction in taxes, and then a actual net or disposable income of $548,500. So that's the net gain of $51,500 to the client's cash flow post making this investment and filing their return. Okay, so that's an example of how an investment into this historic ARC fund would work. Again, we do limit, I will clarify, we do limit the charitable deduction to 2.5 times the investment amount. So even though legally we're not obligated to do that, we're doing that out of an abundance of caution, and that is what a lot of our accounting partners, from the CPA community have requested when we put this fund together. So we do artificially limit it there. So for this $200,000 investment, you're getting a $500,000 charitable deduction. Example number 2. Getting into the 1031 sector. So this client has $3 million of AGI, California married filing joint. They also have a $10 million asset that they'd like to sell with a $5 million basis. So the client would be facing a $5 million long-term capital gain on the property. And we're going to show a strategy of using a 1031 into a historic structure and then performing the historic preservation easement, and then ultimately liquidating that asset in year 10. If you look on the left, what you'll see is the sale price at 10 million, the taxable gain of 5 million, their federal and state taxes in the state of California at 1,855, leaving them with a net asset of $8,145,000 of cash. Now, if that client were to come to us and take this existing asset and 1031 into one of our historic assets, they would get the deferral on the gain for that building. So they'd pay 0 in federal and state taxes. They would have just using a 2.5 to 1 multiple, they would have a $25 million charitable deduction from their historic preservation easement, which gives them 15 years to utilize that tax deduction. And the taxes saved at that client's tax bracket over the 15 years would be $12.4 million for a net asset, which is the building, the new building, plus the tax savings on the easement, minus the long-term gains liabilities that they would have when they liquidate the other asset in the 10th year. They have a net total assets of $20,588,000, and that does not count any rental income that they receive over the 10 years they're holding the building in the 1031 exchange. So you can see this strategy for the right individual, and I realize that not everybody has a $3 million taxable income. Again, there's different strategies we can kind of pair this with. There's different ways we can structure this. This is just an example. It's meant to just provoke some thought and questions. And there's a lot of different ways we can structure this with folks that have, less taxable income. The annual cash flow assumptions. So this is really walking you through kind of the year by year math on that strategy. The long-term gain income from the sale of the building in year 10 for that particular year, the client would have the $3 million of ordinary plus the $5 million of capital gains. So they have an $8 million AGI in that particular year. We're actually going to offset, because the charitable deduction is 50% of AGI, we're going to offset the first $3 million of ordinary and then $1 million of the long-term gains. So in that particular year, you can see that's a very efficient utilization of the charitable deduction. And so obviously we made this example, we kind of reverse engineered the math on this one. That's why we use the $3 million of ordinary income, because that uses up the entire $25 million charitable deduction at the end of the 15 years for the total benefit to the client of the $12.4 million. Okay, moving on to, that's not strategy 5, that should say strategy number 3, tax-free Roth conversions. And I'm using tax-free in quotations because obviously I'm sure you guys are all aware that a Roth conversion is a taxable event. We have the third poll question open. If everybody could do their obligations there and get that taken care of, that would be great. So when we jump into a Roth conversion, obviously your conversion is taxable income. It's treated as ordinary income. So what we're going to do is we're going to look at a situation where John Doe has a $250,000 IRA, traditional IRA, that they would like to convert to Roth. And they would like to do this in a tax efficient manner, of course. The number one reason folks don't convert to Roth isn't because they don't think it's a good idea. It's because they don't want to come out of pocket and foot the tax bill today to have the benefit of the tax-free growth for the next 20 or 30 years. Okay. But I'm going to show you what the math looks like on using that in conjunction with an investment into ARC. And it might change that conversation for you and your clients. So over here, the client had $1 million of ordinary income. So we're going to do a $250,000 conversion, which bumps their AGI to 1.25 million. Okay. They're going to make a $250,000 investment into ARC, which is going to generate in this particular situation with the California tax bracket, it's going to generate a $375,000 tax refund to the client, which makes them cash flow positive $64,375 in the first year. Now, if that wasn't good enough of an incentive, when we look at the tax savings on the Roth conversion after 20 years, assuming a 7% compound annual growth rate and the current tax rate at liquidation, the total tax savings on that Roth conversion after 20 years would be $486,613. When you combine that with the hypothetical conservative estimated cash flow from the investment they made in the current year into ARC, the $250,000 investment, conservatively, we believe they will generate a return of $476,875. That puts the combined lifetime value of this transaction at just shy of $1 million to this particular family. And that's just in the tax savings and the returns on the investment in the Historical Preservation Easement Fund. Okay. So whether your client's at $1 million of AGI or $500,000 of AGI, now integrating these Roth conversion conversations and topics, we can show a pretty compelling opportunity along the way here. Now, the fourth and final strategy we wanted to highlight before we get into the Q&A section of the presentation is how to perfectly blend long-term capital gains with ordinary income. So we're showing you an example here where this individual has, again, $1 million of ordinary income. But in this example, they're also going to have $1 million of long-term gains, pushing their AGI up to the 2 million threshold. Okay. When someone has a long-term gain event, blending, if we have the opportunity to blend that perfectly with ordinary income, then an investment into a vehicle like ARC is going to make a tremendous amount of sense, because as you'll see, I'm putting a $400,000 investment into ARC, which is going to get me the $1 million charitable deduction. That $1 million is going to offset 100% of my ordinary income at the highest brackets. And it's going to leave me with only $1 million of long-term capital gains income, which are going to be at the lower capital gains rates. Okay. So for somebody who might be in a low tax state, but have an event like this, they could wipe out $1 million of income at the 37% bracket and only be left with $1 million of income at the 23.8% bracket. Okay. So it's a very powerful tool for folks that have, a lot of corporate stock, stock options. They want to sell or liquidate a piece of real estate, but they have a low basis in it. They want to get out of the market now based on kind of they feeling like we're at the peak of a real estate market. Folks that are looking to sell and exit business and go into retirement who want to obviously maximize their net, free cash flow from the transaction. Typically when you sell a closely held business, there's going to be some sort of a combination of ordinary income as well as capital gains income treatment. So these examples are great ways to show how you can really leverage that and take it to your advantage. In this particular example, the client would have been $103,000 of positive cash flow in year one after making their $400,000 investment. And the lifetime cash flow from the investment that they made would be about $763,000. Based on that, we feel these are some pretty strong, compelling strategies that everybody can implement immediately for 2023. I'm going to open things up. Victoria, I don't know. I think there's a couple of questions in the Q&A there, but if you want to go ahead and we can start taking some questions.
Oh, yeah. Okay, let's do that. Okay, so the first question is from Eric Sheldon. What is the year 6 FMV of investment? Does the money go back to the client?
Yes. So the way the fund is structured is the clients, the investors all own the assets. ARC is just the manager of the assets. At a very high level, it's a 7% cumulative preferred return to the investor. They have to get their 7% before we share in the profits. After they get the 7% of their investment annually, and again, on a cumulative basis. So if we don't make it the first year, we got to make up that shortfall in the second year's, preferred distribution. After that, it's a typical 80-20 split. Investors get 80%, the manager takes 20%. And then our incentive is on the back end. If we perform on the exits, if we can return 100% of the invested capital before we liquidate the assets at the end, the ratio flips to 20% investors and 80% managers. So that's where our incentive is to perform on the backside of this investment. So the way the fund is structured, the investors own whatever the fair market value is. Fair market value is set by third-party appraisals on all of the assets every other year in the fund. It's a 5-year and a day hold period to not have any recapture on the charitable benefits. So we will liquidate the entire portfolio early on in the 6th year. And that will be distributed back to the investors according to that waterfall schedule.
Okay, and then I have another question that came through the chat. It's from Jason Rossler. He said, I need to understand how the investment in ARC generates a higher charitable deduction than the actual investment that is made.
Okay, so let me go back to the slide that I think really illustrates that. And let me, so question number 4 is up on the poll for everybody. If everybody would take a second to do that. So we are artificially limiting that charitable deduction to 2.5 times the investor's basis. How we get to determine what that charitable deduction is through a highest and best use analysis. So we bring in third-party architects, engineers, market study groups. We do environmental drilling on the properties. We approach it the same way a developer would approach it, and we say, okay, legally, from a legal zoning perspective, what's the most valuable thing we could, if we wiped this property down to the ground, right? So we took the historic building off of the property, and we started building up, and we maximized our opportunity with that particular parcel of land. What would be the most valuable property we could erect, right? And the example I'm giving here is, the market study group comes back to us and says, hey, Steve, the single most valuable thing in this market is apartments, high density apartments, right? So you're going to put a 20-story building in, and this is actually very close to the Raleigh property that we have in the fund this year. It's currently a 2-story, 30,000 square foot office building, but the highest use of the property would be a 20-story apartment tower with about 190 apartment units in it. A little bit of retail on the first floor and the second floor, but that would be our highest and best use analysis on this particular property. It's going to cost us about $50 million to build that structure. And then once it's fully leased out, if we wanted to sell it on the open market, we would generate about a $90 million sale from that asset. So the difference, or the profit that we would get as the developer, is the difference between the 90 and the 50, which is about $40 million of profit. Well, by permanently putting the deed of preservation on this property, and by having all this, the ability to substantiate all of this through the engineering and architectural plans that we've developed, the zoning reviews that we've done, the environmental studies that we've done to show that this 20-story tower is not only legally possible, it's physically it's physically possible that we could build it, but it's also economically viable, meaning the market will absorb 190 apartment units in downtown Raleigh. And then the last criteria, which is it's got to be maximally productive, right? So we kind of meet all of those 4 criteria of the law for what is the highest and best use of a property. The appraiser can take all of that information in, and they can value the property based on all of that data. And it's very similar to how you would look at comps on a house, right? They're going to go out and they're going to pull comps of other, apartment complexes in that particular market, Raleigh, Durham, Charlotte, and they're going to say, okay, what are these buildings trading at? What is a 200-story high-end apartment complex trading at in this market? And that's ultimately how they come up with the valuation. And then they look at real construction data to say, okay, hey, here's the architect and engineer's plans for this building, and here's what it would cost to actually build it, right? So they use real data to validate that $40 million of profit, and then the appraiser signs off on it, and they say, okay, yes, based on everything that you provided us with the architecture, engineering, drawings, blueprints, plans, zoning reviews, market studies. We agree with your assumption. Here's the valuation of your easement. It's $40 million. Now that comes back to the fund, and we hold 10% of that back. So we would actually only pass a $36 million charitable deduction through to our investors. And the reason we hold that 10%, even though we're staying below the 2.5 to 1 threshold, that's just another way to deter any kind of valuation battle in court with the IRS, because they would have to claw back that 10% of valuation held at the partnership level before they would actually impact any of the deductions that our investors have taken. And for anybody who knows anything about the court cases that have gone on when the IRS challenges valuation, they only win about 7% of the cases. So it's a very, very unproductive exercise on the IRS's part. So as long as we have the substantiation and the data, and we've done all the things that a developer would have to do to show that we can legally construct this hypothetical project, our investors would get that $36 million charitable deduction, which means in this particular example, on a $36 million deduction, I'll divide that by 2.5. That means our maximum capital raise in that hypothetical example would be $14.4 million. So we'd bring in $14.4 million of investor capital. We would give out a $36 million charitable deduction, assuming that everything panned out as expected. And that's how we maintain that 2.5 to 1 ratio on the investor's basis. So hopefully that answers that question. May have been a little bit into the weeds, but sometimes that helps the understanding. Any other questions, Victoria?
Yes. Okay. I have one from John Acker. For the Roth to ARC case, where do the cash distributions come from?
Yeah, good question. So when you get into these Roth examples, it's going to come down somewhat to the client's situation, right? So if they have the cash available to make the investment into ARC, we can go that route. If they don't, sometimes depending on their age, you can actually, if they've already had a Roth for better than 5 years and they're over 59 and a half, there would be no penalties or taxes for doing a withdrawal from the actual Roth account that they just converted, to use some of that money to fund the investment into ARC. And then they could actually, flow, the contributions, potentially back into ARC, that way. So there are different ways to go about doing that. Typically what I like to see, though, is that somebody has the available, if somebody's in $1 million AGI tax bracket and we're doing a $250,000 or $150,000 Roth conversion, typically they're going to have the cash available to make the investment in year one to offset the taxes. Okay. Then in subsequent years, so if I come back over here, when this client gets their tax refund, I went too far, apologize about that. But if the client got their refund, if they made this investment in this Roth conversion, in 2023 at the end of in the fourth quarter, like right now, when they file their return in April, they're going to get a $314,000 tax refund. Well, that will obviously recoup more, depending on their taxes, equal to or more than the $250,000 investment that they made. And they can either, repay wherever they took the $250,000 from, or in a lot of cases, what we do is we roll it forward. And now this year we say, okay, hey, I've got $314,000 of cash available. I can convert, instead of $250,000 into my, Roth IRA, maybe I can convert $350,000 or $400,000. So then we can build year over year to help them with their Roth conversion strategy, because it's typically not just like a one and done. I'm going to do it once and that's it. It's typically, hey, how do I utilize this over a couple of years? Also, it works very well for business owners who have quarterly estimated taxes. If you have a client in that situation, if they invest early on in the year and do the Roth conversion strategy, as the tax preparer, you can modify those quarterly estimated taxes to equalize the cash flow for the client throughout the year. So that's another strategy that works as well. Any other questions?
Yes, we have one from Mary. It says, what is the minimum investment and what does the client need to qualify their income?
Good question. So it is for accredited investors only, which means they have to have as an individual 200,000 of annual income, as a household $300,000 of annual income, or it's either the income threshold or the client has $1 million of net worth, not counting their primary residence. Our minimum investment is stated at $100,000 in the PPM in the offering documents. As long as we have a CPA signing off that, or an enrolled agent signing off that the client meets the criteria as an accredited investor, we can waive those minimums to bring it down to whatever level is necessary, as far down as $25,000. Okay. But we do, again, for regulatory reasons, we have to ensure that all investors are accredited.
Okay, and then I have a question from Eric. It says, I have elderly clients, one client 90 years old, sold her home this year with at least 1.5 million gain and moved to a facility. She doesn't have a lot of other income coming in, but would she qualify for one of those options you presented?
Yes, there is no age restrictions on this. In terms of the client's age and mental capacity, that's a decision that her advisors are going to have to make. Whether that's her children, beneficiaries, whomever that might be, whoever's in charge. If the person still has the mental capacity to make their own decisions, that's fine too. But yes, there's absolutely no reason that they cannot take advantage of this strategy, make an investment into art to offset those capital gains.
Okay, and then I have one last question that came through the chat. It says,
I'm sorry, Victoria, I just want to add one thing to the end of that.
Sure.
This investment can also be made through any type of revocable living trust or any kind of trust structure that the clients may already have in place. So it's not limited to individual title. These things can be titled to trusts and family limited partnerships or whatever the structure may be. Anything that the tax benefits will flow through to the ultimate taxpayer, we can work with any structure that's necessary.
Perfect. So the last question is, for those wanting to do conservation easement, does it matter if there are any encumbrances such as a mortgage on the property? Also, what is the typical turnaround time for clients wanting to set up a conservation easement? Could it be done between now and the end of the year to get the benefit in 2023, for example?
Really good question. So I'm assuming this question is around somebody who already owns property. So I'm going to base my answer on that assumption. The short answer is it would be really tough at this stage in the year to get one done. If it really threaded the needle and they had good, clean title work and zoning reviews already conducted on the property, it'd be worth a conversation to look at it. Generally speaking, we need to start that process no later than like September 1st to get all of the third-party due diligence done to the point where the client can confidently, use that tax deduction. The encumbrances is an issue. You cannot have a mortgage on the property. However, a lot of lenders are very comfortable with these easements, and they're very willing to work with a property owner to allow them to place the easement, because they know that it ultimately, if you have a landowner that's doing their own conservation easement rather than selling it off to other investors, the banks understand that that's improving the borrower's financial balance sheet. So they tend to be very flexible in working with that in most of my experiences.